Hello and welcome to episode 10 now, episode 10 already of the Sales Syndicate podcast. It's going to be slightly different than the last 9 episodes in that we're going to be, I guess it's a bit of a lesson. So it's sort of Sales Triggers 101. We're going to kick off by just introducing my guest today. So I'm going to hand it over to Nic.
Thanks very much. So yeah, a bit of an insight really in terms of different ways of working within the world of sales and how different opportunities can come about, whether that's from a recruitment standpoint, whether that's from departmental spend. There's lots of different opportunities out there within the world that will signal to change within an organization that ultimately then leads more into opportunity for you guys as sales reps. So in terms of where we really want to start and focus this is particularly around what we call sales triggers. Sales triggers come in an absolute multitude of opportunities and different variations. So this may be things from more of a merger and acquisition between an or two organizations. It may be from a new partnership announcement, could be from a new contract that's been awarded. And ultimately, where we really want to do within this series of the podcast is to run you guys through all the different opportunities, what they mean within an organization, but more importantly, actually, what can these opportunities lead to and how do they then lead into departmental or recruitment spend? So, yeah, that's what we're going to be going through over the next couple of weeks.
Then I was going to say, in terms of that phrase "sales trigger," it's exactly what it says on the tin. It's an event that triggers something to suggest that a business might be growing or divesting. For example, laying off staff, hiring staff, etc. As you've just said. So there are, there are hundreds, but we're going to go through just over 100 in the coming weeks, which sounds like a lot, but they're going to be nice bite-sized chunks, and hopefully tune in, week out, to run through the full suite that we're going to be talking through. So we're going to kick things off this week with, I would say perhaps, the most, not popular, but the most well-known, the most obvious, would you say?
100%. I think it's the one that everybody, every man and his dog, they track funding. Funding is a huge signal for spend. Companies just come into a nice pot of cash. They ultimately, attached to that are big expectations within growth, within hiring, and ultimately bigger targets that they need to achieve. So a lot of that then tightens up around, looking at processes, procedures, adding more people into the organization. It will lead to a multitude of it. But I think where people actually, perhaps miss a lot of opportunity on this is, just in terms of the different variations of funding and actually then what that can mean for that organization. So really that's what we want to go through today.
And I think we're going to go into, I think, 4 or 5 sort of subcategories within funding rounds. So, I'm going to sit back and Nic's going to do most of the talking here, but we'll kick things off with debt financing as the first subcategory within funding rounds.
Yeah, so just with this, and again, just to provide some clarity, really, again, where everybody or majority of sales reps look at funding, many of that is going to be around venture funding. So anything that's backed by a VC or private equity, that's typically the go-to. But to start this off, debt financing is a very, very different way of looking at that from a growth perspective. And quite often this will be with fast growth startups, scale up companies that ultimately will obviously be in a lot of debt in terms of what their product and things where it's more looking at a long-term gain for that business. So what happens within this perspective is actually organizations will help finance that debt to bring that back closer to a net zero in terms of revenue and EBITDA, in order to buy into the longer opportunity of the business. So it is kind of as what it says on the tin. But ultimately what is happening within that, these are often large injections of cash because, probably a great example of this would be somebody like Klarna. They are looking at very much long-term gain with their model. where they are going out and they're financing opportunities for businesses. They have ran up huge volumes of debt, but obviously the longer term potential of that business is huge. So what we'll often see here are very large injections of cash where investors or banks are looking to essentially buy into that longer term vision of that business. But as with anything, with that, they are expecting a return on that investment. And so this then very much goes into the larger play across that business and again, fueling that future growth. So where they're able to claw back money on their P&L, they are then able to invest that once again back into their day-to-day operations. So whether that is around new tools, again, that the business needs to improve processes, procedures, and everything else in between, or whether that's actually adding to headcount to ultimately, focus on growing the revenues from day to day. So it's a very different aspect of funding, and one that not a lot of people really track. Because where they look, as I said, is typically around the VC or PE funding. Debt financing is very different, but the major difference here is probably the volume of the cash that's being injected. Typically, with debt financing, it's probably going to be the biggest injection of cash outside of any other opportunity that's out there on the market.
And I mean, well, Klarna was, what was it, in the realms of 500 or 600 million, wasn't it? Maybe even more.
Yeah, exactly that. I think, and don't quote me on this, but yeah, in terms of their investment, again, that was a huge injection of cash, a couple of 100 million that enabled them to claw back some of that debt. But ultimately, what they did off the back of that, and I think we've all been subject to this, there were huge layoffs across the company earlier this year. Basically, that's more around a restructure to focus on profitability of the organization. But since um, that debt financing round, they announced that they launched a new product, which they've then taken that out to market. And ultimately, what they have done off the back of that is they've been adding in more tools and more from a headcount once more to enable and fuel that growth further moving forward.
Okay, so debt financing, even though when I guess you're scrolling down your feed and you see the word debt, you think bad, debt financing can be even more of an opportunity than the traditional round. So the second, you've already touched on the venture funding, so we might as well cover venture fundings next.
Yeah, so this is the one that I would say everybody is familiar about or have an understanding to a degree in terms of how this works. But as any startup scale up, you will then go out at some point from that realm of being bootstrapped as an organization to go out and get external funding. And essentially, what also comes with that is a better network, as well as potential better expertise that organizations or individuals can bring into that business to aid its future growth. So venture funding really comes at a multitude of different stages. You'll typically start to see organizations, and you've probably seen this through different wordings or descriptions in terms of what the funding is. So typically what you'll see is in the early stages, you'll perhaps see a seed fund, which may be, quite a small amount of money, but with a very small business. So that money starts to stretch a little bit further than you would imagine. You would then go up to a venture round, which would typically be then with a early stage VC or venture capitalist injecting money. So a VC, just for clarity on that as well, tend to invest more so within the early startup organizations within a business. And then typically we'll then move into what is known as a Series A investment. So that realistically, that is that company's first real injection of cash. This is often where you'll start to see these values of money start to stretch into the millions, and that obviously starts to aid serious growth. But with that, actually what comes off the back is big heavy influence from a venture capitalist in terms of expected targets for the next year, over the next 12, 24, 36 months. Because ultimately what they're doing here is they're risking their own capital. And what they're doing is, again, buying into the futuristic or the future of that organization. And ultimately, they want to get their returns. So typically what you'll see here is a valuation then based on this business, and that will vary massively. And that will also change with the markets. So I think, SaaS organizations this year, they've been looking at around 11 times valuation. So what that looks at is actually, the ARR that is within the organization, so their annual recurring revenue, and they'll look at them valuating that business at 11 times that value. So this is where you can then start to see that growth and expectation in terms of, okay, if that company was going to be bought, this is now what that is now valued at and what it is worth. As we start to move on from Series A, these volumes or values of money will increase dramatically. So this is where you'll start to see your Series A, Series Bs, Cs, Ds, E, F, Gs, and some of them will go even on further past that. But where the real difference is here now is typically an organization will start to move into more of a profitability model. But this is where you'll often get PE firms starting to step in. So those are private equity. They are generally a lot bigger, and what they're doing is investing in a multitude of businesses and essentially spanning their risk opportunities across multiple different organizations. So at the end of the day, they may invest in 20 and one makes it, but that one then, in terms of the money that they put in, is worth 10, 11, 20 times the initial value that they have put in. So again, as we start to go through these stages, as I said, through Series A, B, C, etc., this is then where those quantities of money will increase incrementally throughout those stages as well. But these big investments of cash, I say, come with a lot of expectations, a lot of pressures from outside influencers. But ultimately, they're the injections of cash that an organization needs to really stretch and move through its business cycle.
Okay, so debt financing and venture funding done. Credit facility is the third on the list.
Yeah, so we're probably now getting into the realms of some areas that, again, not a lot of people will track. But actually, they're still investments, they're still injections of cash, and ultimately that money is being brought in to fuel that growth and potential and future potential. So credit facility is probably a bit of I say a bit more of a strange one, but it's essentially a pre-approved loan for that organization. But what that company is able to do is they're able to borrow that money on an ongoing basis over a longer time frame. So it's not so much as a quick injection, okay, here's a couple of £1 million, off you go. This is more of a strategic play over a longer period. So it almost helps gradually kind of increase that runway of that organization. So whereas typically on a startup model, organizations may be running at a run rate anywhere really from maybe 8 months to kind of 24. Some may stretch outside of that, but that's probably typical. And what that essentially means from a runway perspective is taking into account their current revenues, their current overheads. When I say overheads, I mean everything, whether that's office space, staffing costs, everything else in between. Where is it that company can run to based on those metrics before they run out of money? So what this credit facility starts to do is it starts to basically increase that runway because they suddenly have a consistent injection of cash throughout that period. But again, what a lot of organizations will then do is say, okay, well, we've now increased our run rate to 36 months. We're happy running at 24 months. So they'll start to spend that additional 12-month run rate. And this again will go into fueling growth for that organization. So this may, and not in all circumstances, but it may be an organization that's struggled to get venture funding due to outside conditions or the market, whatever that may be. And actually, this is another opportunity that it can start to go in with a different route of funding that essentially can help fuel that growth throughout the coming months.
Okay, and then it's sort of I guess a brother or sister to venture funding, but the fourth one we're going to speak about is crowdfunding.
Crowdfunding is a very kind of different approach. So crowdfunding, you'll probably be familiar actually with some much larger firms that have done this. People like Brewdog, for example, Monzo did this in their early stages. But ultimately, rather than going out and going to VCs or PEs and saying, look, okay, invest in our money and inject, we want 10 million pounds of your money to, this is what we're looking at from a metric point of view in terms of our growth. This will be your return. Crowdfunding is going out to the general public. So this is around, and I'm sure there's lots of sites out there that offer this where people can start to build up profiles. But typically, this will be where a company has got a footprint in the market, or a brand that the general public will be aware of, and perhaps have faith within. And obviously, you're asking them to risk their own cash, but it allows them to go out to the wide general public. So, whereas the real difference here is obviously looking at credit facilities or debt financing or venture, all of a company's accounts are scrutinized within this, and that's across everything that you can imagine, from, again, staffing costs. It may be actually what tools have they got, are they paying too much, what's the profitability of that business, again, what's their run rate, etc. That is a huge aspect that is a lot of influencing factors which may actually turn a decision maker off in terms of actually pulling the trigger and investing that cash. The difference with crowdfunding is that the general public don't generally get to see a lot of this information, or they could probably dig a little bit deeper, but realistically, they probably don't. So we're going out to the wider general public here to basically invest smaller amounts of cash, but on a larger scale. So rather than looking for one or maybe two people to invest, you're suddenly potentially looking at thousands, and you're spreading that risk across multiple people. So a lot of people, I say, have done this and really helped grow through. One, obviously, very, very close to us that did this very, very well was Tiny Rebel as a brewery. They went out and they've actually built their whole business based off that initial crowdfund. So that's the difference, is you're able to spread that risk, and ultimately those members of the public are buying a smaller percentage of that organization and looking for a much longer term of investment. So it's a nice, quick, easy injection of cash, where ultimately organizations will go out and say, look, we're going to close this on the 31st of December, but actually we're spreading that cost across thousands and thousands of people, but still getting that injection of cash into the business by a set date. So it's a different method, but it probably comes with a lot less risk from a business owner's point of view. But again, off the back of that, it is still there to fuel and aid growth within that organization.
Okay, and then the final one we're going to touch on is grants.
So grants is, again, a bit of a cherry on top, really, because whereas with all of these others, in terms of venture, credit, debt, even crowdfunding, people are owning a part of that organization. So they are looking at, owning part of that. When that company either goes public or it goes through a sale, they get a payback in terms of the percentage of that organization that they own. A grant is very different, because a grant has no expectation in terms of company ownership, but it also there's no expectation in terms of paying that money back. So it is straight up front in terms of, here is a lump of cash, go and spend it, no ties attached. Now, the real difference is, again, as much as this is aiding growth within an organization, it is obviously being put in place for a reason. A grant is generally of a much smaller value than the rest of them that we've mentioned. So this will typically be, it may be from government schemes, it may be actually from, trying to grow new markets in an area. So you'll have organizations within that will work very, very closely with subsectors of the market. It may be actually they have a bit of faith within that organization. They're willing to give some investment within that to enable them to grow. And that can be from very, very small grants, helping business owners get offices. It may be actually for a couple of new hires. It really does span, but that will spread, I say, right across from local councils to government, to industry, kind of schemes and things that are run up on the outside. So again, it's still there to enable that growth, or to give research, or it may be actually R&D that business is then investing in ultimately to enable their growth. But it's still an opportunity or a signal that organization has money and they are ultimately they're being given that money because there is potential within it, and an expectation that that business is going to grow.
Okay, so we've touched on the 5 sort of main subcategories within funding rounds. So just to recap: debt financing, credit facility, venture funding, crowdfunding, and grants, all of which are there to aid a business's growth, to support customer expectations, which in turn, or which would subsequently mean that the business is going to spend money on tools, they're going to hire new members of staff. Obviously, these 5 things are great. We want to track them. So if you were going to, after this podcast, you were going to go online and you're going to go, right, I want to start tracking those 5 funding rounds. In a real world scenario where you don't necessarily have a tool to track this, where are you going to track those 5 different triggers?
There's a lot of different ways you can do this. Probably the hardest piece of this is to get that information within real time. Now, typically, this is where I'd probably encourage people to look outside of venture funding and start looking at these other opportunities. I think you said it perfectly earlier. Quite often where people see debt financing, they're thinking, "Oh no, don't want to touch that. That's bad." Actually, no, it's great, because that company is in a lot of debt for a reason, but there's people still investing in that because there is a huge potential further down the line. So number one, it's looking outside of your general remits or where everybody else looks. But the trick to this is you've got to be quick, because once somebody's had funding, I promise you every sales rep in this world is reaching out, because again, they're like, they've got money to spend. I want it to be with me. So there is a real emphasis here in terms of getting that information at the right time. And ultimately, if you can get it in real time so that you can really act on that as the event is taking place. Also, there are other tools and things out there as well where you can start to predict when organizations are going to go through funding. A huge one, because quite often by the time this is announced or it's released, it's too late. So the ability to get in there ahead of that event taking place is massive, and I would really encourage anybody listening to this to start looking and researching the market in terms of what can do that. But ultimately, in the short term, different ways of which you can do this. Crunchbase, they have a free model where you can start to filter through funding rounds within there. You're not going to get all of the content, but you will certainly get some. But also start to track some of the bigger publishers or the localized news around the markets that you're swimming within. So this may be on the likes of LinkedIn, where people are announcing this obviously to their network. It may be people are doing write-ups to announce that funding within local papers and things like that, but also across some of your major publishers, so the likes of Bloomberg, Reuters, people like this. These things will get announced, certainly if they are at that stage. If they're a significant business, there's going to be great opportunity to do that. And as part of this, you can start to set up, really, really simple things in terms of likes of Google News and Google News alerts. You can specifically start to do this within the news as a keyword funding. You can start to be notified when these events take place. It is a report that you will have to run on a daily basis in order to keep up with that. And don't forget, some of these things may be announced in the AM, some may be in the PMs. You might be wanting to be keeping an eye on that throughout each day. Other options as well are again on the likes of LinkedIn, where you can start to filter via companies that have had funding within the last 3 months, for example. You can start to run these reports, but I say just be warned, it does require you to be within that each and every day and running that search multiple times a day as well, just to ensure that you're getting that information there in real time. So look, if you're looking for something that helps streamline your day a little bit more, you get things instantly, start to look around the market around different tools that are on offer. There's plenty out there that can help you with that.
And I think, even on those funding rounds there, you've just mentioned Google Alerts, you've got LinkedIn as a resource, so that's 2. You've then got company newsletters or company websites, that's 3. Industry reports, that's 4. Crunchbase as an example, that's 5. And then you could get other, I don't know, an intelligence provider or whatever. So that's 6 different resources alone there that you're using to track just those 5 figures. And if we just assume that the average rep might have a hot list or a target list of say 50 accounts that they're trying to connect with. 50 times 6, that's 300 things you're going to have to be keeping an eye on for those 50 accounts, which is arguably almost impossible, which is why we're sort of saying, if you were going to be looking for a provider like Selligence to streamline this for you, you could be saving anywhere from 3 to 5 hours a day. So, 30 hours a week per rep. And it just goes to show that, you want to be ahead of the game with these triggers, but in order to get ahead of the game, it is a mammoth task.
It's huge. I mean, I could sit here and probably name 52 now. We're scraping and aggregating from over 2 million different sources. The market is huge, but as a kind of starter pack, if you like, there are tools out there that can help you do it. But I say it's just reliant on yourselves, keeping on top of that, keeping in touch with each minute of the day, each hour, in terms of what's happening within the market, what's being announced, and ultimately you're going to start to see those volumes change as well throughout the calendar year. Typically, obviously, December generally a quiet period. There's probably not going to be many announcements from a funding point of view, but as you start to move now into Q1, early part of Q2, you're going to start to see that ramp up. Ultimately, in terms of where the UK is right now, especially, big talks, obviously we're in a recession at the moment, outside influencing factors are also going to affect that as well. So it is going to be, a game in terms of how quickly and how much can you keep on top of it. But I say as a starter pack, there's something to keep you going. Ultimately, you're looking for something more longer term in terms of getting that information in real time. Then, start to look at the market. Have a look at Selligence. Tools like that can really help and aid your day to day.
Okay, so episode 1 in this mini series talking about sales triggers, we've covered off funding rounds. I think next week or the next episode, whenever that might be, we're going to be talking about expansion plans. But hopefully, it sort of sparked an interest. You're keen to learn more about sales triggers, and we look forward to see you in the next episode. But thank you to Nic for jumping on, and we will see you in the next episode.